What's going on, guys? It's GBPJPY. Welcome back to another video, and today I'm just going to explain what a breaker is and give you different examples so that you can go in the charts and look for them yourselves. Now I will draw a diagram of what a breaker is first. So this is what we'd call a bullish breaker, and I'll show you what I mean by that. So a breaker is basically the last up close candle before the down move that then causes the expansion to the other side. So this right here would be classed as a breaker, so we can draw this out, and then what we're expecting and anticipating price to do is return to it before trading on higher. So let me make this more clear. So this level here will be a significant sell stop or pool of liquidity. It might be a low or it might be a fair value gap, but generally it's a pool of liquidity. So we're looking, it might be like a previous low. What will happen is price will dip down into it, pull back out of it, and then go back in lower to basically run out stops and then trade on higher and reverse. You're probably confused as to why this level has to come down there first. Remember, this is a significant low, so this low could be from ages ago. But then what you'll also find is there's this low as well, which pretty much acts the same. So again, we're just looking at this high right here, and what you'll find is that there should be a up close candle before the down move. And what we would usually do is we'll draw that out, mark out the 50% level, and we're looking for price to come back into that before trading on higher. So now we're going to identify this in the charts. I will just quickly show you a bearish version of the same thing. So we'll have a significant price level. Price will trade into it one time, like this, pull back out, and then it will run stops, and then it will simply reverse. And then what will happen is price will drop down. We expect or anticipate price to return back to it, to go short, and then price will run on lower. So again, the same thing. We need a significant pool of liquidity to get ran. So this could be a previous old high. Price will go through it once, twice, and then it will reverse. And then we're looking at the down, and in this case we'll be looking at the last down close candle before the up move. And you can see price trades into that, and then we'll trade on lower. And again, what you'll find, again, we're looking at the whole candle. So we'll draw that candle out, drag it right through, and we're looking for price to respect that and then trade on lower. So you can go short here, maybe put your stop above there, and then we may be targeting a previous low or a fair value gap in the discount. So that's it on a very basic level. So I am going to just quickly go through a few examples. So right here, we're looking at the same thing. We have this low right here, but this whole move down is running out stops. So we need to find out what stops it's running out. Let's see if we can find them. In this case, we're trading into a fair value gap. So let's draw out the low of the fair value gap. So this will be that red level I was talking about right here. And then it dips down, and this is that secondary level I'm talking about. So it's the same thing. Now we're looking at the last up close candle before the down move. Where's that? Right here. So we drag that, we draw that out, and we're looking for the 50% level to get respected and to go long there, stop loss below here, and then we're targeting a previous high, for example, right here. Now obviously this is easier said than done, and I can go into more detail maybe in another video. But here's this will be an example of a breaker. Excuse me. Simply go long here as it trades down into it with the expectation to go higher, and also time of day plays a role. But I'll speak more on that in a different video. I'm just showing you what a breaker looks like. Another thing to take note of as well, for it to help us realize it's a breaker, we need to see movement. Like we need to see expansion. So you see this large up close candle and how we close solidly above this high after trading into a significant price level, low, high, lower low, break higher, last up close candle. We need movement, and this, look how price is running. There's 4 candles to get up here, only one of them is down. There's a lot of movement there. There's not a rule about it, but you can see movement, you can see expansion, and you can see a willingness to go higher, and again time of day. But nonetheless, that would be our first example. Let's now look for another example where this occurs. So just to show that this can happen on any time frame, I am going to just go on the daily on a different pair, and I'll find another example of this. So here we have some sell stops. that we've come down and grabbed. There's also sell stops here as well. So this is that first initial red level I was talking about. So make this red, and this is just another sell side target. So we'll have that marked out anyway. And then this would be that secondary level I was talking about below the actual low, but this is just delineating this sell side. So these are those two levels. And remember, we want to see a low, a high, a low, and then a willingness to go higher. And then we're waiting for price to return back to it. So last up close candle, why? Low. Remember, this is a significant level. Low, high, low. Willingness to go higher, last up close candle. Drag that out. And then as price trades back into it, we can go long. We trade back into it here, and you'll see that we also trade back to it again at a later point. Now, what's interesting about breakers is the fact that this is typical for price. This is typical for breakers to be returned to. So you can get in on the move as you're trading higher, because remember, this is the daily. If you got in on this low and went long up to here, above this high as a target, that would be a beautiful trading, short-term trade. Or if you're doing it on a higher time frame, what we'd do is obviously like on the daily, you'd wait for price to come back to it right here, and then you go long, stop loss below there, and then would be obviously at that point we'd want to target higher prices such as this high and these highs. So that's our second example. Let's now look for one last example, and I will use another pair. Let's use GBPJPY for example. So here we're on the hourly on the GBPJPY. So this example is different because we're not keying it off a previous high. This time I want to show you how we can use the same, theory, but without it necessarily trading to a significant level. So let's say we got a high, a low, a high right here, and then price runs. As we're seeing price move away from like this and start to break on lower, especially at this rate, it's likely that we're in a reversal, especially depending on the time of day and obviously the day off week. With this taken into account, we can now anticipate price to return back to that breaker to try and set us up and get us on the right side of the market. So what's happened, we created a high, we created a low, we created a higher high, so we've ran these stops. And if we drop down to the low time frame, this level, so if we're on if we drop down to like a 1 minute, this level would be that initial significant level I'm talking about. It's just that we're looking at it on a higher time frame, and I'm showing you this example without having to have keyed off previous data. My point, nonetheless, so this is that secondary level, high, low, high. As soon as this candle here closes below this low, so as soon as this happens, this is the change in the state of delivery, meaning that from here on, price is now bearish, and now we wait. What are we waiting for? We want to see the last down close candle get traded to. When I'm looking at this, we're looking at volume, so we want the biggest volume. But what we can do is we can also couple them together, but because they're both order blocks. So let's get those drawn out. The last down close candles before the up move. The reason I'm using both is because, like I said, we're looking at volume mainly. We can just use one and it'll still apply, but in circumstances like that, I'd use both. So we trade on lower, we wait, price then returns back to the breaker, and look how volume's treating the low of it. It's because this is the change in the state of delivery. Volume doesn't need to go back in here. Go short, stop loss above there, and then of course that's when we start targeting lows such as this low right here. That would be my target, and I get out down there. Again, easier said than done, but it's the same process. High, low, high. We're looking at that last down close. We're waiting for a return. Why? Because we've had an expansion, lower, and again, time of day and all sorts will be taken into account. It's also nice that there's a fair value gap lining up with this. When you have a fair value gap lined up with a breaker, that's a very high probability setup to go short in. So that's not another thing to look at. So I hope you guys learned something. Don't forget to smash subscribe, join the mailing list, join the Discord, all the links are in the description, and I'll catch you guys tomorrow. Peace.